Welcome to Digital Asset Report. I'm your host, Kavita Gupta. In the last couple of weeks, we have all talked about the infrastructure bill, mainly because of POS and especially because of the decentralized finance. The whole world is talking about 20% APY, 40% APY. What is decentralized finance when regulators have just started understanding what cryptocurrency is? Today, we have a founder of one of the biggest and the most successful decentralized finance protocol, Compound, Robert Leshner. Robert Leshner is a CEO and the founder of Compound. A graduate of University of Pennsylvania, he's also the former chair of the San Francisco Revenue Board Overnight Committee. Before Compound, he founded Safe Shepherd, a privacy-focused startup that provided customers with information about how their personal data was being used and what they could do about it. And before that, he was working at Postmate, leading its merchant division. Hey, Robert, how are you doing?
I'm doing great. Thanks for having me.
Thank you so much for taking time out. Especially now, Robert, the DeFi is on everyone's mouth. Like back in 2017, when you started Compound, did you see like the time frame by 2021? Everyone who probably didn't even buy crypto now wants to get into DeFi?
Well, things have unfolded faster than we anticipated. In 2017, there wasn't a phrase DeFi. There was a small number of projects that were using smart contracts to automate finance, but we didn't even know what this would become at that time.
Yeah. So let's go back to your journey, Robert, right? There was a time from Postmate to then starting a very interesting privacy startup, which I think is so much needed today. How did you come across crypto and then blockchain and then create Compound?
So early on, I actually dismissed it as an investor because I thought that it would be impossible to create a currency that would compete with the major world currencies. When Ethereum came out, I was also generally skeptical that you could have extremely complex computer programs running on blockchain. But my eyes were open to the idea that this could work when there was a program called the DAO, which was created, which wound up failing in a spectacular fashion. But it proved that you could actually create a computer program to manage assets and have a global community.
Now that gets you, but in the financial space, right? I know you have a degree in economics, but your work profile hasn't been hardcore into finance or hedge funds or creating fixed income derivative product. How did you end up creating Compound?
I realized that one of the things that was missing were interest rate markets for crypto assets. At this point, there was lots of people trading on centralized exchanges, and there was lots of people starting to experiment with decentralized exchange. We took a lot of the knowledge that I had of how existing financial markets worked and tried to come up with a similar process to bring them into crypto.
So, Robert, as you went into this journey, right, back in 2017, I was investing as Consensus Ventures managing partner. I remember at that time, we were still talking about scalability, transactions per second. Like I was literally scouting for projects from Polygon to Starkware and all these things, which still came in 18 and 19, right? How did you even think Compound is going to work back in 17?
There were very few sort of like important financial use cases. And so there wasn't that much competition for transaction space. And so, we always assumed that somebody would solve these issues, that there was a lot of brilliant people working at it from within Ethereum, alongside it, as you mentioned, L2 scaling solutions and, parallel scaling solutions. And we thought, we're just going to focus on building the best possible financial product and expect that the blockchain will eventually work to be able to accommodate this use case. And since then, transaction costs have only gone up, which is problematic. As transaction costs have increased, it's made it harder for the average user to economically interact with the protocol. But, we designed it at a time in which, there was a very small amount of competition for gas costs.
That's true. But the gas cost has become now a way for people, especially the pool providers, syndicators on different DeFi products, to move from one platform to another platform. But before we go there, what is Compound? According to you, if you have to explain it to people who have no idea about it, what is Compound?
Yeah, so Compound is an interest rate market for different crypto assets. And it allows you to borrow a crypto asset, oftentimes a stable coin or an asset that you'd like to sell, using different crypto assets as collateral. So, instead of the protocol lending you assets based on your character or how much it knows you or a credit score or your reputation. It's willing to extend assets to you based on collateral you're providing to the protocol. And on the other side of this, you have users who are earning an interest rate, knowing that there's basically no risk of default and that it's a transparent and safe way to earn an incremental yield on the crypto assets that people hold. So it's really focused on two different sides of the marketplace, borrowers and those looking to earn an interest rate. And it makes this available for stable coins and volatile crypto assets.
Very beautifully said, Robert, and very clearly. So DeFi has been in news because people have been getting 20% APY to 40, 50% APY. And suddenly people are feeling like, oh, I've been sitting on crypto for so long, BlockFi, Salt, etc. were my only choices. But now with DeFi, I'm in the game and it's very interactive. What has triggered for a high return like this? And secondly, with the high return, suddenly there are so many new protocols and so many platforms in the space, which has also incurred a lot of new products. So let's start with what has caused such high returns?
Right. So all of the returns come from somebody on the other side looking to borrow and looking to pay a high interest rate. Or, it comes from the distribution of governance tokens. At the end of the day, this comes from, there's always being someone, whether they're paying an interest rate to borrow an asset or paying an interest rate to purchase a token. It comes from demand on one side. And that demand is really expressed as yield for somebody providing liquidity or providing assets to the system.
So do you see that people would continue to have such higher interest rate, or where do you see mostly DeFi is going to find its balance?
Well, I expect that long-term interest rates in DeFi and interest rates in most major economies are going to reach an equilibrium. And most likely this will be realized by the interest rates in DeFi coming down, not the interest rates in most major economies going up. And, I think this is a function of a couple things. So one, DeFi right now is very hard to interact with. You're oftentimes custodying your own crypto keys. You're interacting with smart contracts through Web3 web pages and interfaces directly. It's a very complicated process. It's not easy for most of the world to bring assets into DeFi. It's still very complicated and cumbersome. So as more assets slowly come into DeFi and the process becomes easier, the availability of capital is going to decrease the yields. And so I think that's the first thing that's going to decrease yields in the long run. And the second is going to be that as this market becomes more efficient and it gets easier to move assets and arbitrage between legacy financial markets and DeFi, you're going to have huge institutions eventually serving as this balancing act where they, will be able to say if yields are too high in DeFi, move capital in from the rest of the world, or if yields in DeFi are too low, move assets from DeFi into legacy financial markets. There's a small number of hedge funds that are starting to do, DeFi interest rate arbitrage and things like this, but it's still not a large market.
Oh, interesting. So the DeFi Pulse reports that there's approximately 54.8 billion, when I checked last week, asset under management in the whole DeFi world. And you think that's not big enough yet?
No, I don't think that's big enough yet. I think, over the next couple of years, I think DeFi is going to have $1 trillion of assets in it. And, this might sound like a lot today, but if you look at how rapidly DeFi has grown, I don't think it's unreasonable. When we started Compound in 2017, the first year that the protocol was live, it amassed about $10 million, $20 million of assets in it after a year. After another year, it was up to 100 million. And then after another year, it was up to 10 billion. If you look at, how much is in DeFi today, it's only one more, major growth wave before we can get to $1 trillion of assets. And so, my prediction is within 2 years, there's going to be $1 trillion of assets in DeFi.
I actually agree. And I think it's going to be faster than 2 years.
Much more on the digital asset report when we come back.
Welcome to FinTech TV, a global media platform for digital assets and sustainable investing.
My name is Kavita Gupta.
And I'm Vince Molinari, and we are so pleased to be back at the New York Stock Exchange.
Our signature shows, the Digital Asset Report, focused on the global ecosystem of blockchain, digital assets, financial tech evolution, and The Impact, a show focused on credible social entrepreneurs, impact investors, We reach 850 million households globally. This is FinTech TV.
So what's your take on infrastructure bill, Robert? And especially the way governors and lawmakers are not really able to understand how to tax staking, yielding, farming, etc.
It caused a lot of pandemonium because they were basically trying to bring crypto into a regulatory regime. It doesn't exactly make sense. They don't fit together very well. And there was calls for, the legislative process to slow down. None of this is finalized yet. I think it's very early and there's still going to be some changes that unfold. But, the most impressive aspect of it was that the crypto community in the US was able to rally together so quickly to make their voices heard and to enact change in the legislative process. And I think that's a positive for crypto investors around the world.
Yeah, no, absolutely agree. And I think there has to be a lot of education around it, right? One of the last thing which we covered in our show was that how right now between CFTC and SEC, they're still figuring out who has crypto under them when it is commodity versus security or other products. And NFTs, another place, they don't even know how to figure out the regulations. So DeFi is a complete next level. DeFi is among very deep crypto adopters who understand how the product works. I don't think it's ready to be that much regulated yet. That takes me to my next question, Robert, because I see that so many new products from flash loans to different new products are still coming out in the space. What has been your favorite, if you have to pick one or two products in last year or about to come, has been your favorite?
Yeah, that's a great question. I'm most excited about bringing DeFi to non-fungible assets. And I think I'm interested in this area because non-fungible assets today are starting off mostly with art and collectibles. But non-fungible assets are going to be, I think, one of the largest use cases of DeFi, which is representing unique real-world assets like buildings and real estate. The first couple years of DeFi was dominated by fungible tokens. All look the same. To trade tokens, to borrow tokens, to hedge tokens, really focused on fungible assets. And I think the society started to create very good financial infrastructure around fungible assets. And so the area that excites me the most are all of the experiments going on right now with trying to bring financial systems to non-fungible assets, whether it's trading, whether it's borrowing, whether it's fractionalizing them, whether it's insuring them. I think that's the next frontier. And it's really interesting, not when I think about it for art, but when I think about it for, the eventuality that real estate is, represented as NFTs on the blockchain.
No, I absolutely agree with you. And I think NFTs are going through a very early stage of revolution. There's so much to do. I was recently talking to an art curator in India who told me that one of the most famous artists in the country is now exploring how to have a fractionalized ownership of his really beautiful but super expensive piece to have more accessibility to people. I would say, Robert, if not compound, outside compound, if you have to pick one or two other decentralized financial product, which one would you pick?
So my two favorite products in general are Uniswap and MakerDAO. And I like these projects for very different reasons. So I like Uniswap for the simplicity of the product. They've built a system and evolved the system over time that's exceptionally powerful for a very simple use case, which is trading tokens. And I like MakerDAO because I think they've innovated and succeeded the most on creating a decentralized community to govern their protocol. And they've made tremendous progress. I'm most impressed by those two products for very different reasons.
No, and those two products pretty much set up the tone for the DeFi community too. Very exciting. So Robert, our show is on CNBC Africa, and we have a lot of viewers. And the crypto revolution in Africa actually has been super fascinating. You have companies like Paxos and Bitleba and BitPesa in the space. Have you seen any, do you see regional customers coming on your space, or is there a volume? which you think that Africa is doing something big or small in the DeFi world?
Yeah, well, one of the best things about DeFi in general is that, it's globally accessible. So Africa has the same ability to interact with DeFi as pretty much any other, continent on Earth, right? And so the second is that developers can be located anywhere. The barriers to creating DeFi applications are extremely low. And because you don't need to have permission or build into existing financial markets, I actually think that Africa in a lot of ways has an advantage over more developed countries because there's obviously a lot of demand for entrepreneurship. And when the barriers are lowest and equal across the entire globe, I actually think that continents like Africa are well positioned to develop DeFi applications and develop innovations in the space. And so it's hard to say exactly where a lot of users are coming from because crypto is pseudonymous. But anecdotally, we've seen developers who are interacting with DeFi and building DeFi applications in Africa, in India, in Asia, everywhere. And I think that trend is going to continue to see a lot of excitement coming from Africa.
I think this is a perfect time to have Anush and Namish joining us from India, our FinTech TV India contributor. Hey, Anush. Hi, Namish.
Hey, Kavita. Hey, Robert.
So based on all the amazing conversation about DeFi, and there's just so much happening in it, what are your questions for Robert?
Robert, I have a question regarding traditional finance, right? We've seen, and you've discussed it, with elaboration that DeFi is all about right now. It is right now about, borrowing, lending, and doing everything with crypto assets. My question is regarding when do you project that we will be able to sort of have real world assets? Like, we could be able to collateralize our home and take a loan on top of it from anywhere in the world, right? My question would be, do you see it happening? And if yes, then when?
Yeah, that's a great question. So I think the answer is it's going to happen. It's just not going to happen extremely quickly. And the reason why I say this is I look at stablecoins as the best analogy. And that stablecoins came out of left field. I don't think people are anticipating stablecoins. And it took years for them to grow into what they are today. I think there's already some very simple experiments with real world assets being tokenized and brought onto blockchains. There's a number of projects that have started to try this with real estate. There's certain ones that have tried to start to do this with off-chain loans that they basically like tokenize and try to bring on chain. But it's still very early. And, there's a saying, which is it takes a long time to become an overnight success. In a lot of ways, I think that speaks for stablecoins. It took a long time for them to become an overnight success. And I think the same thing is going to happen with real world assets. There's already a lot of teams testing and trying to come up with different ideas. And it's not going to happen, possibly this year or possibly even the next year. But I think one day we're going to look up and there's going to be $50 billion or $1 trillion of real world assets on chain. We're going to say, whoa, where did that come from? Even though it's been happening, already.
Robert, and I completely agree that the silver lining on this was the entire community coming together. However, there was one amendment on the bill which favors proof of work over proof of stake. And this sort of tells you that the government is slow at understanding new technology.
It's moments like the infrastructure bill where everybody gets up off the couch and says, hey, we have to quickly educate you because you're about to do something that's less informed than it should be. And I think these moments actually serve as a really good opportunity for legislators and politicians and regulators to increase their familiarity. There's a lot of senators in the US who weren't really excited about crypto even 2 weeks ago. And today, it's pretty much all they're talking about. And so, this is a positive thing. And so I think a lot of the government, at least in the US, is starting from that same place of not knowing anything yet, but being open-minded. So, I don't think a lot of folks even knew the difference between proof of work and proof of stake, things a lot of us might take for granted.
Robert, building on top of that, on Anush's question and your answer, do you think regional places or regional hubs would again become from the legislative perspective and especially tax perspective something more influential? Like a lot of DeFi users may move out of US. Do you think that's going to happen? And which regions do you think is going to be hubs now?
Yeah, so I think there's absolutely the possibility that teams move out of the US. We've already seen a lot of US teams leave the United States to organize their companies in other countries and not have a physical presence in the US. And I think that serves as a detriment to the US long term. I think one of the things that the United States did extremely well with the internet is they were extremely hands-off, and they were extremely, cautious about imposing any regulations. I think the risk is that, the next major global, powerhouses won't be built in the US if the regulatory structure isn't welcoming to innovation.
Yeah, very well said. And I think this is also very much connected to what we have been talking in India about the crypto regulations, and talking to our government saying, let it free, let it be, because this is a next technological revolution, not just a financial one. Thank you so much, Robert, for taking time out. It's been a very informative and educational piece for our viewers, and hopefully we'll have some more people having APYs on your Compound platform. Thank you.
Thank you for having me, and it's been a pleasure to speak with all of you.
Thanks, Robert.
Welcome to FinTech TV, home of Exponential Voices, a global media platform for digital assets and sustainable investing.
My name is Kavita Gupta.
And I'm Vince Molinari, and we are so pleased to be back at the New York Stock Exchange.
Headquartered in New York, where we are constructing a state-of-the-art broadcast studio, along with our studio stock exchange partners at the NYSE, NASDAQ, and LSEG, among others. Plus correspondents and contributors all over the globe. We reach 850 million households globally, with a unique blend of online viewership and traditional TV networks. Our signature shows, the Digital Asset Report, focused on the global ecosystem of blockchain, digital assets, financial tech evolution, and legislation and regulations surrounding the sector.
I guess my question to you then is, A, are you a believer that Bitcoin is the, I don't want to call it the Holy Grail?
The way I think of Bitcoin is a global currency. Individual countries will continue to have their stable coins.
And The Impact, a show focused on credible social entrepreneurs, impact investors, family offices, and the grassroots warriors amplifying the needs and progress of the UN Sustainable Development Goals. Plus ongoing special series. Pat Mitchell, Dangerous Women Leading Onward. Roy Wood Jr., Faces of Race. SSE TV, UN Sustainable Stock Exchange Initiative. Price of Climate. Unique content on a global media platform. This is FinTech TV.